Hello and welcome to Livewire The Pitch. I'm Ali Selby. Investing in China has been on the nose over the last 2 years, but now investors are returning to the region in droves. So to find out if you should too, we're joined by Amit Goel from Fidelity International. Thank you so much for joining us today, Amit.
Hi, Ali.
Let's talk about the China CSI 300 index. It's rebounded around 13% since hitting a low in early February. Do you think Chinese equities can continue to surprise in 2024?
I think when you talk about Chinese equities in 2024, you have to think about what happened to Chinese equities in 2023. China was a market where everybody was concerned about geopolitics, everybody was concerned about domestic politics, everybody was concerned about what is happening on the domestic consumption front. And that's why I think it was the most hated market. I think I've been investing in China for the last 12 years, and the amount of pessimism that I've seen on China has been greater than ever in last 12 to 18 months. So I think there was a massive disregard of what is happening on the ground because of that top-down view on China. And that's why we saw foreign investors selling China by the amount they have sold. Markets have been sold down excessively last year, and that's why you see this bounce back. There's no data improvement as such. I mean, it's just that things have started to be less bad. And they have been sold to such cheap valuations that it makes all the sense to buy Chinese equities at this point in time. Less bad news, it's better capital management, and I think that can continue this year without data being even good in short term. And then I think in medium term, next 12 to 24 months, data can cyclically improve as well, and that can add further upside to Chinese equities.
Okay, are there any risks though that you think investors should be aware of? I know there's that adage that we should buy when there's blood in the streets, which there definitely is in China at the moment, but those risks are, as you talked about before, geopolitical and trust and transparency and everything like that. How should investors approach value in the region, and what risks should they keep in mind?
So the two big risks that I see is geopolitics and demographics. Like, geopolitics is a very general risk, and I think in my view everybody has been talking about that for the last 2 years, which means that it might be priced in as well. I mean, it can be binary as well, so nothing is priced in when it is binary, but I think everybody who could have sold China has sold China last year. So that is also a reflection of how people are looking at that risk. But I think from a medium long-term perspective, I think demographics is also a higher risk than it was. Demographics, we all knew that China gonna age, China gonna slow down. But what we saw in last 2 years is that the birth rate collapse in China was higher than expected. I mean, China birth rate went from 1% to 0.5% in 6-7 years time. It was supposed to be 0.8. So I think, and demographics are easily predictable, so everybody has some expectation of how demographics would be. But I think China demographics have worsened more than what they should have in normal models. But we don't know. This is such a short span of time, two years, in a very long duration of demographics. So it might be cyclical as well. But I think from a medium to long-term perspective, as a risk for a bottom-up stock selection, I put a higher weight on demographics. For top-down risk, I put a higher weight on geopolitics, but I think geopolitics is something which is increasingly getting priced in as well.
Okay, so with that in mind, how would you approach value in the region? Would you be avoiding certain sectors that have exposure to those demographic headwinds?
Once you get sense of the demographics, you can easily align your portfolios to demographics. The key is whether the country can still grow at 3-4 real, which we think it can, and how demographics can change that growth profile. I think China has still become productive in parts of the economy which can drive growth. So I still believe that 3-4% growth is possible. And then you can change your portfolio with respect to demographics. I mean, there will still be categories where consumer will spend more on healthcare services. As you age more, you spend more on that. On education, you need to upskill yourself as you go along. You spend more on sportswear because you want a healthy lifestyle as you age more. There will be categories where actually even worsening demographics will improve them. So you can easily modify your portfolio. I think at this point in time, we are still not sure that whether these demographic changes that we saw in last 2 years are more cyclical or structural.
Okay, given all the risks that we've discussed today, what would you say to investors who still remain reluctant about investing in China?
I think what my advice would be to investors is that we should be looking at China in a very pragmatic way. You have to look at what is structural, what is cyclical, and what is priced in. I think you can still have your long-term structural concerns on China, which are valid, but there are a lot of medium-term opportunities because investors have sold these stocks and they are trading at the best valuations we have seen on them in the last 10 years. So I think it would be very risky for investors to ignore those opportunities. I think some of the opportunities that I see in China are the best I have ever seen in the last 10 years. So this is the time actually to be more greedy, but with the sense that you have some of these long-term concerns, so you have to manage how you have your exposure on China.
Is it possible you could take us through a few examples of where you're seeing the most opportunity today?
So, I spoke about China consumer being a area where I'm very much focused on. I think it's very cheap relative to market, relative to their own history on an absolute basis, on a relative basis. I think this is probably the only time in the last 12 years of my investing where you can probably throw a dart and buy any of them. But if you specifically ask me, I think sectors like staples, dairy sectors. I mean, there's a company called China Mengniu Dairy. You go to sportswear sector, there are companies like Li-Ning, Anta, Chinese beer sector as well. So I think these are sectors where you have consolidated industry structures. The bigger companies are getting bigger, they are taking share. The underlying economies are either growing through pricing, through premiumization, while volume growth is low, but they are becoming more branded. They are taking share, consumer spending more in these categories. So I think some of these names, categories are trading at such reasonable, I would say, throwaway prices as well, that it doesn't take a lot in terms of growth or improvement for you to make money in these companies.
Okay, well, thank you so much for your time today, Amit. It was awesome to have you on the pitch.
Great, thank you.
If you enjoyed that too, don't forget to subscribe to Livewire's YouTube channel. We're adding so much great content just like this every single week.